Changes in how Canada's capital gains tax is calculated may have an impact on many people's estates, but there are strategies to reduce the tax burden. Joining us via Zoom to discuss this is Paul Lindsey of MacMillan Estate Planning. Thanks for being here, Paul.
Pleasure. Thank you, Jen.
So can you recap the changes brought about by the federal budget in case people aren't aware or remember?
Yeah, of course. What the spring budget did was it changed the way that the capital gains are taxed in our estate. Now, historically, half of the gain would have been subject to tax, but unfortunately, well, for us as taxpayers, post-budget, whilst anything up to $250,000 is still taxed based on half of the gain, anything in excess of that is taxed based on 2/3 of that gain. Now, if you incur those taxes inside your business, you don't benefit from that $250,000 buffer. Basically, everything in that business, all of the gains, taxed based on that 2/3 sort of process.
That's a huge amount. So you mentioned, so what can people do to manage or eliminate tax in their estate?
I suppose all is not lost. The first thing to bear in mind is certainly as individuals, we all have the ability to use the primary residence exemption. So if we sell our house or it passes through our estate when we die, irrespective of the amount of gain in there, it isn't subject to tax. And it's the same story with our tax-free savings account. Now, as I said, the budget was not pleasant for business owners, but what it did do was it increased something called the lifetime capital gains exemption. And this means that if you hold an interest in a qualifying farm or a qualifying business, the first $1.25 million of gain is not taxable. And that actually is a little gift from CRA because historically it was just $1 million of gain that was covered by that exemption.
Okay, now you mentioned that businesses are particularly affected when it comes to this. So is there anything specific that a business owner can do?
Well, there are two particular strategies that we're using at the moment, and the first one is called an estate freeze. That allows you as a business owner to freeze the value of your business for tax purposes, certainly when you pass away. But whilst you're alive, it allows you to mitigate taxation, as I said, through your lifespan, and it also allows the growth and the tax on the growth in the business from, say, this point on to be generated in a tax-deferred manner. Now, if we can structure this in the right way, and of course, if the estate qualifies, that exemption, that lifetime exemption I mentioned, can be used perhaps for you, maybe your spouse, kids, grandkids, to essentially keep millions of dollars insulated from tax in your family. And then the final point is we can actually tax shelter part of your estate, which again, as a business owner, means that the tax burden when you die can be reduced substantially. Because as a business owner, if we do nothing about our tax situation, when we pass, the effective rate of taxation could be as high as 66%, which is quite alarming, quite frankly.
Wow, 66%. Holy, okay. Well, thank you so much for your advice. We do appreciate it. That is Paul Lindsey of MacMillan Estate Planning joining us. Have a great weekend.
Thank you.